Hey everybody, what's going on? This is Fabian Calvo, founder and president of the Note House, and also creator of the coming Resourceful Real Estate Investor Academy, which will be rolling out in 2013. But I wanted to just take a little time and kind of give a holiday message, if you will, and talk about 2013 and what the Note House is expecting in the market. And I think just real critical information to any investor out there, again, whether you're starting out or you're an experienced investor that's been doing this for decades. I think much of the information we'll talk about in this audio clip will be informative, and I think it'll serve you. So, I get asked all the time what I expect for 2013, and as we pause here for a week or so, and that's for me what the holidays are, regardless of what a religious affiliation you may have. It's a time to spend time with our loved ones and to take a little time away from work, which for some of us can be difficult since we love what we do, and we love to invest, we love to do deals, we love to be involved in the markets. But it gives us time to reflect and to think about, where we're at as investors. How could we become better investors? What opportunities are we maybe missing? And again, that's what we at the Note House hope to be of service to you, and just not just do the education, but also to do deals with you, to be able to find you the type of product that you're looking for, and with some real exciting projects we have in 2013, be able to again be that conduit for finding off-market deals by leveraging the hundreds of trading partners that we've formed great relationships with. So I think that first, no talk about the real estate markets can be had without first talking about the Federal Reserve and monetary policy. I think that's extremely important, and that's what I think sets us aside from other real estate firms that are out there that just basically pitch real estate or invest in real estate without concentrating on the other big issues going on in the U.S. economy and really all the economies of the West. So as it stands today, we have the so-called fiscal cliff debate going back and forth. I think this is really an artificial crisis. I mean, tax rates will be going up either way, and I think that stems more from the $16+ trillion in debt. I mean, the United States is borrowing money to pay the interest on the debt it already has. At the same time, it's monetizing the debt, which means that the Federal Reserve is in essence printing money, creating money out of thin air, and is lending that to the government of the United States. And that history shows us usually does not end well, and it ends in inflation, and many times can end in hyperinflation. Now, I think that, again, when you look at real estate and you look at where real estate is going, it's pretty clear to me that the Federal Reserve has made an open commitment to keeping interest rates artificially low. And it also understands, as do the big banks, the big U.S. banks, and some of the big banks that are offshore as well, that they understand that for the U.S. economy to turn around, for it to have a real recovery, real estate must recover as well. And so in order to experience a recovery, what we've seen is we've seen a lot of collusion, we've seen a lot of manipulation, and we see that certainly in the stock market and other asset classes. But in real estate, I think it's probably one of the most manipulated markets currently. By the first example I'd give is the interest rates, right? Ben Bernanke at the Federal Reserve knows that if he raises interest rates, not only what it would do to the United States government with respect to the debt it has to pay, but also what it would do to real estate prices. Real estate prices would crash significantly. I mean, even now with rates at all-time record lows, which we know they can't keep forever, with rates at all-time lows, they're not really seeing the type of home purchases they'd like to see. So I believe, and we at the Note House believe, that rates will continue to be low throughout 2013. And the Federal Reserve is on record saying that they're going to keep these rates low until they see unemployment reach a certain amount. And I believe that is 6.5%. And I think that will be there maybe in a couple of years, perhaps, but not because this economy is necessarily growing, but because more people are opting out of the labor pool, which is really the only reason why we've seen a reduction in the unemployment rate from the mid-8s to low 8s to the high 7s. So we don't believe the economy, I don't believe the economy is necessarily growing and functioning like a strong growing economy should. I mean, you look at the holiday shopping spree that's taking place now, and we have an economy that's built on debt. It's not built on savings, and it's not built on investment. So these companies are, watching Walmart shoppers leave Walmart, and they're counting how many people are leaving and how much people are putting on credit cards. Well, that's not a really strong economy that is fueled by just more and more debt. And that's what we have here in America. And eventually, we believe that's not going to end well. Now, I'm not necessarily doom and gloom. I'm actually really optimistic about real estate in the next few years, and for investors, I think it's an opportunity of a lifetime. But what I am saying is that long term, the economy as it's set up currently, a consumer-based economy fueled by debt only, is an unsustainable model, as is the $16+ trillion in debt that the U.S. government has, as is the Federal Reserve expanding its balance sheet from $800 billion at the time of the crisis in 2008 to now almost $3 trillion, and many expect $5 trillion by 2015. Totally unsustainable, and I think that's important to understand. So with rates staying low for the next couple of years, well, what does that mean? I mean, that's big because we have a lot of people that think housing's recovering. And when you see the Case-Shiller index go up 3%, people start, to get this buzz, and I think it's really pushed by the media as well, that, housing's good again. Let's get back in there. And I can tell you, at the Note House, we've seen an unprecedented demand in the retail market. And I'm talking prices, not wholesale investors / prices. I'm saying the retail market, investors chasing yields in the 6 and 7% range, because that's much better than they're getting in the bank at less than 1%. In fact, losing money when you factor in inflation, you're losing money if you keep it in the bank. And many don't trust the stock market and the fluctuations and the volatility that can take place in the stock market. So between the interest rates being kept low, there's another big component of the manipulation taking place in real estate, and that's the banks, in essence, keeping all of this shadow inventory. We have a pool of REO homes that we're buying in Ohio, and we had one of our analysts up there, John Bloomer, the last week, and he was just absolutely impressed and almost amazed by the amount of vacant homes in Ohio that don't have a real estate sign, they don't have a for sale sign, they're just sitting vacant. And that's part of this shadow inventory. And I was at a Raymond James event about 6-7 months ago, and I heard a statistic that just blew me away, that on any given night, and they had all the charts and everything else, on any given night in America, there are over 20 million vacant homes. I mean, that is a staggering amount. And then as we speak right now, we have over 4 million homes that are in the foreclosure pipeline. So that's something that I want to talk about as well, is foreclosures, because of the manipulation by the banks and suppressing inventory, what they're expecting is that prices will continue to go up, and then they can sell these assets into a market that is into an appreciated market, and instead of selling these assets into a market that's completely declining, and they would take even more losses. So what they're doing is that they are releasing the inventory very, very slowly. So for the average investor, in fact, I spoke to an investor the other day that was telling me, he was kind of upset, saying, there's no more deals in Florida. We can't find any inventory. And really, that's not the case. There is a tremendous amount of inventory. It's just, where do you find that inventory? And that's something that the Note House, and with some of our projects we have going on in 2013, think we're going to really be able to facilitate that for you by being able to give you a tremendous amount of opportunities. And one way to be able to get around the lack of inventory is by buying notes, buying non-performing notes. And when it comes to that, there are trillions of dollars on the sidelines, or excuse me, trillions of dollars in non-performing real estate notes at all different scale, asset level pricing, that one can take advantage of and actually buy less than what they would buy for a typical REO. So the Note House loves REOs. We buy them, we fix them up, we rent them, or we resell them. We may resell locally into the local market to one investor that might want to buy it, fix it up, and rent it, or he might want to fix it up and flip it. But we also love non-performing notes because it gives us the flexibility to be able to do loan modifications or workouts with the owners. And if that's not possible, be able to finalize the foreclosure process, but do it in a way where we end up owning the asset for much less than what we would have paid for the REO. And then at that point, we have more flexibility, whether we want to lease it out, fix it up, rent it out, wholesale it, whatever it may be. So I'll tell you, in 2013, we expect foreclosure rates that, even in spite of all this record manipulation taking place, we believe that the foreclosure rate will continue to go up for many different reasons. If you haven't had a chance to download the white paper that we put out at the beginning of 2012, it really still holds true. In fact, we're going to update it for 2013. But it still holds true, which is the top 3 threats facing banks in 2012. And one of them was the fact that you have inflation hurting a lot of homeowners that are barely getting by in their home, barely being able to make their home payment. So as food prices, gas prices continue to rise, even though we have seen a momentary decline in gas prices, I don't think that's going to last forever. And so you'll have the consumer still hit hard. I mean, it's still a tough job market. And so we think foreclosures will continue to increase. They'll probably be either on par or actually higher than they were in 2011. Remember, a lot of foreclosures were held off prior to the election in November 2012. After the election, we've seen an increase in the foreclosures. I think we'll continue to see that. It's just a question of whether the banks will release this inventory or not. Part of the shadow inventory are the millions and millions of people that are living in their home, not making a mortgage payment. And that in and of itself is like a shadow stimulus to the economy, because those people that would have ordinarily allocated that money to paying a mortgage are now allocating that money towards buying Christmas gifts or buying whatever it is that they're buying. So I want to just take the time to also talk to you about what some of the exciting projects that we have going on in 2013. And just, I guess I should say one more quick comment about the current state of the market, because as I've said, it's tremendously manipulated, but there's tremendous opportunity for investors out there. The Note House is getting yields in the 15 to 30% plus rates. And I really don't even get into talking about the deals that we make 30, 40, 50, even 100% returns on, because I think for most investors, they hear that number and they almost don't believe it. But so, if we just say, okay, well, it's 20 to 30, that's something that people say, okay, well, that's possible. And that's what I want to really hone in on here is that, I mean, again, if you're starting out or if you're new or if you've been doing this for a while, but perhaps you've been frustrated with the market, as an investor was that I just said told me just a couple days ago that they couldn't find inventory in the state of Florida. I want to just urge you to keep coming back to the Note House, watching the educational videos we put out. Look into some of the, if you want to dive a little bit deeper into the subject matter, look into some of the material we'll be putting out in 2013, because I think it'll really serve you in how to find these off-market deals. Okay, we again deal with hundreds of banks on a monthly basis, and I can tell you all of them, for the most part, or for the exception of a few, are selling assets. But they're just going about it a different way, because this is a different real estate market. The market is fundamentally changing, and because of the manipulation, there's just different avenues and different routes one needs to go through to access those deals. So we're excited about 2013 in many ways. One is because we think that real estate will continue to see moderate appreciation, but even outside of that, understanding one of the most important principles as a real estate investor is that you make your money when you buy, that there will be a tremendous amount of opportunity for the coming year in real estate, especially people that are looking to buy and sell, or buy and lease rent out the home or rent out the apartment complex. We still believe that in markets like Florida, Atlanta, Chicago, Northern California, Southern California, even Arizona, Las Vegas, those markets we believe, and so many others, even markets like Detroit, in Michigan as a state as a whole, that there's significant opportunities in all of these states. You just really got to continue to do the activities, to do the work, and finding these deals. And we believe the Note House can serve you. In 2013, we're going to be coming out with a virtual trading platform for all the distressed debt that we own and all the REOs that we own as well. But in addition, we are going to be leveraging the contacts we have with our trading partners, and again, hundreds of trading partners, billions of dollars in deals and non-performing loans that you will be able to access by joining Drenix. And in essence, it'll be a private real estate club that we are going to be forming and putting out that for a pretty nominal monthly fee, I think, at least, especially when you have access to all these off-market deals that other people won't have access to, because it'll be a private real estate club. You'll have access to the deals, but you'll also have a tremendous amount of educational material as well that you can go through and that you can use to your advantage. Because I'll tell you, I deal with real estate investors that have been investing in real estate longer than I've even been alive. I'm 34 years old, and they've been at it for 40 plus years. But I think everybody can agree that the market has changed substantially. It's changed rapidly. In fact, a lot of professionals that have been doing real estate closings or working in real estate for 20 plus years, I mean, I find myself teaching them, hey, here's how we have to do this deal now, because so many things have changed with respect to how to monetize this market. And that's what I love so much about real estate is an asset class that does not discriminate. You can invest with no money. You can start with no money. Yes, the idea that investing in real estate with no money is a myth. I can tell you it's not true. I've completely shattered it. I do it on a daily basis. And for those of you that have money, even the better, right? Because for as little as $10,000, $20,000, you can get into the REO market and buy a couple homes in Atlanta, fix them up and rent them and get 20, 30% yields that I don't know any other asset class that's even possible in a 60 to 90 day span. So Drenix is going to be a great tool for those of you that want to really commit yourselves to making 2013 a prosperous year. In addition to that, if you're interested in continuing to get these informative videos about the market and about everything else, thenotehouse.us, sign up for the newsletter. We'll be sending you out some really good, just free videos that talk about what we feel are some critical real estate principles in this market. So again, the notehouse.us. If you're receiving this letter, you're likely already a subscriber. If you're listening to this audio recording, I ask that you share it with your friends and family that may be interested as well in taking advantage of this opportunity. Here's the last point that I want to make before we wrap it up. And again, this speaks to the market, and it speaks to the amount of opportunity still in the market, because I think it's just a startling fact. The Federal Reserve recently came out with a study that took into account all of the debt that the housing sector has. So these are for people that live in their home, primary home residences, all of the debt. And they took all the values of the property as well to find out how much equity is there. And the total amount of equity was less than 3%. So over 97% of all housing out there that has loans on it, 97% of it is debt. That is a startling fact, because if you believe like we do that low equity rates or no equity rates are a potential for a default and future foreclosure, then that shows you, that one statistic can show you how much more room this market has to go to the downside. But because of the manipulation that I've already spoken to and many other factors, it's a tremendous opportunity for investors to continue to buy, continue to resell or lease and get amazing returns, amazing yield. So I want to thank all of you that have taken the time to listen to this recording. Again, the notehouse.us is where you can get more information, sign up for our newsletter. I'm Fabian Calvo. Thank you for listening. Have a wonderful holiday and a great new year, and I'll see you on the other side of the new year.